World financial history doesn't run on pure RNG. It doesn't move in a straight line to the moon. It moves in cycles, repeating time and time again, wearing different skins but sharing the exact same DNA. The foundational truth: a crisis isn't an accident. It's the inevitable endgame of exactly how the financial system operates. 1929, when hopium gets repriced. October 29, 1929, the U.S. stock market gets absolutely nuked. Wealth vaporized in just a few hours. Investors stood completely frozen, watching everything go to zero right before their eyes. But this rug pull didn't just drop out of nowhere. It was stacked up over years through dirt-cheap credit, degen levels of high leverage, widespread FOMO speculation, and pure hopium that prices would pump forever. Deep dive analysis. This is the final boss stage of the cycle: financial illusion. When the market enters this state, risk doesn't vanish. It just gets blinded by extreme bullishness. This is the ultimate moral hazard. When degens believe they won't face any consequences, they will ape into massive risks. When the market dumps, banks go belly up. Mass bank runs, people pulling their bags out. Businesses get wiped out. Systemic analysis. The most dangerous part isn't losing your fiat, it's the loss of liquidity. When the system runs out of juice, banks stop handing out loans. Businesses run out of capital. The normies have no money to spend. The economy gets completely paralyzed. After that, Franklin D. Roosevelt stepped in with the New Deal. But take note, monetary and fiscal policies are just hopium pills to kill the pain. It wasn't until World War II broke out that massive production demand actually dragged the economy out of the gutter. Deep insight. Sometimes it takes a massive global shock to hit the hard reset button on the system. 1973, supply shock and energy power. 1973, the crisis didn't spawn from Wall Street, but from energy. OPEC slashed the oil supply. Oil prices did a 4x. Core analysis. This was a supply shock. Unlike a financial meltdown, it spawns from the physical world, IRL, so you can't just fix it by printing more fiat. Consequences. Production costs skyrocketed, businesses shrank, unemployment spiked. Special phenomenon, stagflation. High inflation paired with terrible growth. Deep macro analysis. Central banks were trapped in a lose-lose glitch. Hike rates, nuke growth. Cut rates make inflation way worse. This is a state with virtually no perfect patch. Strategic insight. Energy isn't just another sector, it's the foundation of the entire game. When energy is controlled, economic power is controlled. 2000, the dot-com vaporware. The year 2000, Wall Street got addicted to a new drug, the internet. You didn't need revenue. You didn't need profit. Just slap a .com on your startup and your valuation pumped to $1 billion. Core analysis. This was the ultimate vaporware bubble. Investors were buying eyeballs and clicks, not actual cash flow. The lesson: when the narrative outruns the fundamentals, gravity always wins. Trillions of dollars vanished into the cloud. 2008, when risk got financialized. The 2000s, the dream of owning a home spread like wildfire. Banks were handing out mortgages like candy, but behind the scenes was an insanely fragile house of cards. Toxic bags of risky loans were packaged into complex financial products and dumped on the global market. Deep dive analysis. This was pure financial engineering, turning trash risk into shiny products, making it invisible to the naked eye. Core mistake: believing that slicing and spreading risk equals deleting risk. Reality: risk doesn't vanish. It infects everything and becomes uncontrollable. This is systemic risk. when housing prices just stopped pumping. Important rule: a bubble doesn't need to dump hard, it just needs to stop going up. 2008, Lehman Brothers got liquidated. Moment of truth. The market realized the entire system was built on a fake trust. The domino effect. Trust goes to zero, lending freezes, liquidity dries up, total system wipeout. This is the ultimate credit freeze. 2020, the global black swan. 2020, a completely different kind of nuke, a global pandemic. Core analysis. This was a pure black swan event. Special characteristic. This crisis dropped a direct hit on supply, demand, and supply chains. For the first time in modern history, the entire global economy was forced to pull the plug all at once. Governments smashed the panic button by slashing interest rates to zero and pumping infinite fiat into the system. Macro analysis. The volume of money printed was unprecedented. Long-term receipts, sticky inflation, massive asset bubbles, and a skyrocketing wealth gap. The great paradox. Financial markets pumped back up instantly while the real economy bled out. This is classic asset inflation. 2022, the great hangover and crypto winter. Fast forward to 2022, the bill for 2020's infinite money printing finally arrived. Inflation hit 40-year highs, the Fed panicked and hiked rates at warp speed. Macro analysis. The era of free money violently ended. Warren Buffett once said, "Only when the tide goes out do you discover who's been swimming naked." The result: over-leveraged crypto funds collapsed like dominoes. Tech stocks got slaughtered. This proved the golden rule. Without cheap liquidity, the fake empires crumble. The master rule: crisis anatomy. Every single crash follows the exact same blueprint. Infinite liquidity, assets pumped to the moon, max leverage, peak hopium, a catalyst drops, total rug pull. High-level insight. A crisis isn't a glitch in the matrix, it is the self-correcting mechanism. The market needs a crash to flush out all the toxic waste it accumulated. The most dangerous truth: the moment of maximum risk is exactly when the chart looks totally flawless. The playbook: making bank in a bust. When the nuke drops, the normies panic sell, but a select few build generational wealth. The core alpha: it's all about mindset. 1. BTFD when valuations break. A crash triggers a liquidity crisis. Blue-chip assets get dumped just like shitcoins. The alpha: scoop them up way below their intrinsic value. 2. Cash is absolute power. When the system is starving for liquidity, the guy holding the dry powder dictates the rules of the game. 3. Farm the volatility. Massive swings translate into massive bags to be made, but you gotta understand your risk management. 4. Track the smart money. The market front runs the news. When the whales start pumping fiat back in, the market will recover before the headlines do. 5. Don't catch falling knives. Nobody can snipe the exact bottom. The cheat code: DCA your bags in tranches. 6. Ride the cycle. The real whale money is minted in the recovery phase. 7. Contrarian alpha. Warren Buffett dropped the ultimate alpha: be greedy when others are fearful. This is cold, hard strategy, not emotional paper hands. The final verdict: the next nuke is guaranteed to respawn. Nobody knows exactly when, but count on this: it will hit fast, it will spread everywhere, and it will be a massive jump scare. The losers, paper hands, trade on pure emotion, have zero prep. The winners, diamond hands, understand the macro cycle, execute their playbook, maintain ruthless discipline. The crash doesn't dictate if you win or lose. How you react to the red candles is the only thing that matters. And the final boss question: when the next nuke drops, will you be the one getting completely wiped out, were the apex predator, building a massive empire straight out of the chaos.